You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time for TWIFO. This Week in Futures Options, a program where, as the name implies, we break down the week that was from a futures options trading and activity and trends and volatility and skew perspective. And of course, you can always follow us live every week on Mixlr every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. If you had that link before, you grabbed it before you bookmarked it, don't worry, same link every time. Just fire it up. You can also find it whenever we tweet it out on social media, and our friends over there at CME and at QuikStrike always tweet it out too if you follow them. So you can grab that link, bookmark it, save it, and then you're ready to go every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. For some TWIFO action, my name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to sink your ears into. The easiest place to find all of them, of course, the mothership, the flagship, theoptionsinsider.com. Just scroll on over there. On the right-hand side, you'll see the call out for all the shows. Of course, while you're there, breaking news from the options market, education, unusual activity, all that great written content as well. Check that out while you're over there. If you just want to mainline the audio, you can always find us as well via iTunes or Stitcher or TuneIn or iHeartRadio, whatever your favorite podcast provider of choice is. We're there. And if you want to get all of them together, the easiest place to get them, of course, just grab the network feed, and you can get every show, all 15 of them, delivered to you the second they are available. It's the easiest place to get the full fire hose, as we like to call it. And of course, you can always grab our app as well, available for iOS, Android, and the ever-popular Fire OS. And however you listen, live after the fact via the app, however you come to the show, make sure you hit us up with those questions, those comments. We do love to hear from you guys. And joining me on the program today, starting off, joining me is my co-host, my partner in crime, my futures options partner in crime, that is Mr. Nick Howard, the creator of a little platform you guys may have heard of called QuikStrike. Nick, welcome back to TWIFO, sir.
Hey, here we are, another week, another show. Pretty fast. Life moves pretty fast, right? Isn't that what Ferris Bueller said? Moving pretty fast on me right now.
That just means you love it. It means TWIFO keeps coming. Every Friday can't come fast enough. You know it's fun when it seems like, another TWIFO already. Another week went by that quick. It's time for another TWIFO. I know I always look forward to it. It's a great way. It's our final show of the broadcast week here on the network. It's a nice little way to look back on the week that was in futures options. Also, personally, one of my favorite theme songs on the networks. I like to rock out to it whenever the show starts. It's always a fun one. And joining us this week on the CME Group hot seat is another CME rep. Nice to put a CME guy in the CME hot seat every now and then. And today's guest is a newcomer to the TWIFO program, even though you may have heard him before on the long and short of futures options program. He is Tim McCourt, the global head of equity products over there at CME Group. Tim, welcome to the CME hot seat and welcome to TWIFO.
Great. Thanks, Mark. Thanks for having me. I look forward to our conversation today, and thanks again.
Let's start off, since this is your first time on this program at least. Why don't you give our listeners here a little bit of an overview of your background and what it is that the global head of equity products does over there at CME Group?
Sure. So in terms of being the global head of equity products at CME Group, what I'm really responsible for is leading our team across the globe as we manage our equity products, both the listed futures and listed options on futures complex, whether that comes from executing the day-to-day strategy, coming up with new product innovations, new rule changes, technology platforms, and things of that nature, just really kind of managing the complete end-to-end offering for our customers and how we continue to grow the business and grow the number of customers that we have in the marketplace. It'll be 4 years tomorrow that I've been at CME, so that's an exciting anniversary coming up. And prior to that, I spent about 13 to 14 years as a sell-side equity index trader. And then, 4 years in, still enjoying my move to the exchange.
Well, I can't think of a better way to celebrate an anniversary than joining Nick and I here live on TWIFO to talk a little bit of futures options action over there at CME Group. And if you want to follow along yourself, of course, you can always stream the show live. You can also follow along live with the reports. Just go to cmegroup.com/TWIFO, TWIFO, and you can pull up the exact same reports that Nick and I and Tim are going to be looking at right now and talking about on the show. And Nick, since we have Tim on and since we did a big hit on indexes and skew last week, I thought it was a good place to start again this week. In particular, let's get into, I know you and I were talking a little bit ahead of the show about how some of the skew is evolving, or perhaps not so much out there in all things equity indexes, particularly S&P this past week. And of course, I always like to talk skew on this show because you guys over there at QuikStrike actually have the QuikSkew tool, which shows not just skew as some net aggregate number, but actually what's going on with the call wing and what's going on with the put wing, so you can kind of see for yourself how the sausage is made. And we were talking about this last time. The QuikSkew was kind of showing that a lot of people were making a lot of hay about the skew being high, aka assuming that it was all put driven. But in reality, the calls were perhaps a little bit cheaper than they usually were, and that was, of course, contributing to this overall perhaps a little bit higher number of skew than we're used to seeing. So a lot of moving parts in this equation. I know you've been digging deep into QuikSkew over this past week. What has been catching your eye out there this week, Nick?
Yeah, we could. I think it's a good starting point, and I'll be interested to get Tim's perspective on a couple things, just because I don't have the expertise in the indexes, and just have some kind of general questions that maybe he can take a stab at answering, and maybe help us and the viewers look at indexes as we go forward. But as we started to mention last week, I think we discussed a couple of articles that were saying that the skew was so out of whack across all the different index products, and it was at all-time highs and that kind of thing. And when we looked at the numbers ourselves, it didn't look like anything was really that out of the ordinary in comparison to where things have been of late. But when I go and I do look at the QuikSkew is composed of a call ratio and a put ratio, and as part of the QuikSkew chart, for anybody that's seen it before, we plot those two pieces on the same graph, and it lets you get an idea of how the puts and calls are related to each other, and also how they're related to the at the money from a volatility rich or cheap standpoint. And what we've seen here, and probably more so this week than we did last week when we looked at it, we said we didn't feel like there was anything really interesting or out of the ordinary happening. But what I think I've seen this week, and just looking at the charts, is that the calls are definitely less cheap than they were, and the puts are definitely less rich than they've been. So from a net standpoint, we might not have seen a tremendous difference in what the skew numbers have looked like, although that's not the case. If you are on the TWIFO report, you can see that in the volatility columns on the report itself, you're going to see a lot of greens with arrows pointing upward for the actual call minus put risk reversal volatility value, the difference between the two, the volatility value. So we've seen an increase where, it's become more positive. And these numbers they're still negative. They're still biased to the put side, but two things are happening. We have super low volatility across the board. So these percentages themselves, when you look at it as a percent rich or cheap to the money, it's a very small amount of volatility from the 25 delta to the money, and then again the money out to the 25 delta call. So we're seeing movement from a positive standpoint. So that's basically telling us. And the thing is, it's sort of, if you just look at the skew number, you can't really tell what's happening, like which got rich, did one get more expensive, one get less expensive, et cetera. But when we look at it, we're seeing the puts got less expensive and the calls got more expensive. So puts are still rich to the money, and the calls are still cheap, but they're starting to converge a little bit toward that at the money volatility. And when you start to look at the volatility levels, vol's down again this week, and even down, I think, let me look at the 50-day option here, and they're pretty flat for today, maybe up a little bit, but down, a vol or better. We tend to shy away from the expirations that are under 7 to 10 days, because that vol is going to move quite a bit to catch up with the decay and that kind of thing. But the 20 days out, 50 days out, everything's down a vol this week. But we're seeing some oddball things, right? Really, really low volatility, less expensive puts, less cheap calls, and that's really showing us when you go out there and you look at the QuikSkew numbers, and if you do check them week over week, which you're able to do, you're going to see things are moving toward the at the money, and that tends to make me think that there's some interesting opportunities out there, or that volatility is getting to the point where it just can't be ignored anymore from the long side, because we're looking at lows that we haven't seen in a long, long time. And I'm sure Tim will be able to talk to that a little bit later on when we throw it over to him.
Yeah, let's just do that right now, actually, because before we get into the actual numbers coming out of the report, I know, Tim, the last time you were on with me on the other program, you guys were really mixing things up in the index options department, particularly in the weekly side. You guys have continued to do so, adding a lot of new listings. Of course, the Wednesday weeklies being a big addition to the arsenal of late. But walk our listeners through exactly what you guys have been up to over there on the index options front over there at CME, some of the new things you're listing, as well as some of the maybe interesting trends or maybe customer feedback you're getting. What are they looking at? How are these things performing out there in the marketplace? What are you seeing out there, Tim?
Sure. So I think what's interesting, right, just to echo what Nick was saying, is that we do kind of find ourselves again in this persistently low vol environment for the S&P 500. But despite that persistent low volatility, we are seeing fairly strong growth in with 1 day to go, one trading session to go here in Q1. Our option complex here at CME is up about 13% in terms of volume over Q1 of last year, and about the same, maybe a little bit closer to 12% against full year. But we're seeing strong growth. So I think what's happening when you see that, despite the low volatility, market participants are still looking for more and more trading opportunities, and that's where the additions of Wednesday weekly options, I think, has been a strong suit for CME, where they're averaging about 55,000 contracts per day so far in 2017. We launched this back in September of 2016, and they've had a strong growth profile since then, but again, about 55,000 contracts per day in 2017. So I think when the lower volatility environment presents itself, you're seeing, more and more trading to the shorter dated, either whether it be event risk or people looking specifically to trade some of the risk premium that may be presenting itself. Like Nick was just saying, that tends to move a little bit more, just given the decay aspect of the shorter dated options. We're seeing customers take advantage of this because they want that increased precision. They want to tailor their market exposure based on anticipated market moving events or potential market moving events. And I think that's one reason why we introduced the Wednesdays back in September. When you look at it, the Friday weekly options have always been successful since launch at CME Group. But when we're looking at things outside of the macro announcements around whether it be non-farm payroll or retail sales that typically are happening on Fridays, we're having midweek corporate earnings announcements, as well as now FOMC meetings are back in play for the first time in a long time. So there's more and more midweek events that customers are seeing. So we think that's been helpful in kind of providing a boon to our volume this year for options, despite some of the futures volume being down as a result of the lower volatility environment. And that's when, when we launched the Wednesdays back in September, we had an open dialogue with our customers and our market makers, and we got a lot of questions around that time about why we weren't launching Mondays as well. And the feedback from market makers back then is they weren't quite sure they were ready for another expiration in the week here at CME Group. But since then, since the launch of Wednesdays, we've had overwhelmingly strong and positive reactions from our customers to the end where on this coming Monday, we're actually launching S&P 500 and E-mini S&P 500 Monday weekly options in response to the strong customer demand, kind of extending that theme I was just talking about, where market participants want an even deeper pool of liquidity to express these views on major market events. And as we saw with Brexit or the U.S. election and now the impending French election, the geopolitical events are no longer comporting to the Monday through Friday news cycle. So kind of these Monday options are providing market participants with some unique weekend protection from a hedging perspective or presenting unique trading opportunities that are more weekend dependent. And that's why we're launching them on April 3rd, this coming Monday, to take advantage and provide trading strategies and our trading opportunities, I should say, for customers to deploy strategies around the French election, which the first round is on April 23rd, which is a Sunday. So I think as we continue to increase the precision and roll some of these products out, I think we're going to continue to see more trading opportunities, which has been a nice counterbalance to the kind of persistent low volatility we've seen since middle of November onwards.
Yeah, you're right. The presence and the prevalence of weekend risk is a quite literal thing these days. We were talking in one of our other programs recently just about the number of, shall we say, market impacting tweets that come out of the new administration tend to cluster around the weekends, and that can always have impact. Of course, as you were mentioning, the global macroeconomic and political events that are going off on the weekend, they don't always conform to U.S. weekly trading hours. So having some products that can actually allow people to take advantage of that, I think, is always a good thing to have more tools in the toolbox at the end of the day. Let's get into some of that actual activity we're seeing out there right now. You were alluding to there, Tim. By the way, you guys, of course, follow along CMEGroup.com/TWIFO. You can see for yourself. Make sure if you want to see the Wednesdays in there as well, go up to the expirations tab over there on QuikStrike. Make sure the Wednesdays are checked. You probably also check a few of those weekly boxes there, because if you don't do that, you're missing out on a lot of the volume that is going up out there. I mean, we've said this before that the narrative. There's been a narrative, particularly on the index side of the fence. It has been very much in the weekly short duration type contract cycle. Everyone seems to want those products. They want more of them. I think we have a listener question about that a little bit later. We'll see if we have a chance to get to that. And they are certainly lighting it up with the weeklies. The number one with the bullet trade for this past week. We're looking at the E-minis to start off here, because I know a lot of you guys like the E-minis in particular. Were the 1975 puts expiring this coming Friday, so the 7th. A ton, shall we say, one mega block of 35,550 going up yesterday on Thursday. Pretty much all that opening. So you see that a lot with the weeklies. You see kind of some clustering of large chunks of liquidity going up as someone has an axe to grind in one particular cycle or against one particular event. And we see that a lot there. We also saw, so that was our number one big E-mini trade for the week, actually, was in a weekly. And we're seeing a lot more of that, which is kind of interesting. And it's going to have a lot of, obviously, other effects across the term structure as liquidity migrates towards the front duration of the curve, how that's going to impact things like skew and volatility and theta and things like that. So I know a lot of researchers are working fast and furious right now to figure out how all this works, and I'm sure we'll get to it again on future episodes, but weeklies are still just lighting it up. Number one with a bullet out here this week. Number two, we're actually a little bit farther out, but it's a close, hotly contested race. But it was another weekly, again, expiring on the 13th. The 1900 puts out here, also lighting it up to the tune of 27,000 and change. Lion's share of that 22,000 going up today. So again, and kind of in keeping, looks like it might have been even a bit of a that looks like a little bit aggressive of a wide spread, but still some 2045 puts also going up as well today, about 11,000. So almost 1 by 2, but that would be an oddly spaced 1 by 2 if that was indeed the case. And that was it wasn't all puts all the time, though, listeners. That was followed closely, hot on their heels, only a few contracts separating them by the regular monthlies expiring. So the April expiring on the 21st, 2,400 calls with about 27,000 of those. Those, as you might imagine, a little bit more spread out throughout the week in terms of liquidity, with relatively equal numbers going up, except for today. Pretty light today, only about 1,000 going up today. But still pretty aggressive activity over there across the board. As Tim alluded to, we are seeing vol still coming in across the board in the S&P and a lot of the broad indices. We saw that little bit of a spike last week as some concerns were feeding into the market, kind of coming off again this week. Of course, we do have events coming up that may change that cycle, so we'll see. I think all of us would welcome a little bit more volatility creeping into the marketplace. You know, we've seen S&P realized vol hovering around a 6 for the better part of the last month or two, and so it'd be nice to see that maybe tick up a little bit. I'm not seeing that, of course, this week. Mr. Nick, I'll toss it over to you. We talked a little bit about QuikSkew earlier. Anything else catching your eye out here, E-minis in particular, and QuikSkew, as well as some of this other activity that's catching your eye out here in the index options this week?
Yeah, I know you got that's a great overview. One thing I want to point out, because this is something I tend to forget, and maybe some of our listeners don't know this already, but a while back the exchange removed the serial contracts and moved those to perform as weekly contracts. So when you're going out here and you're looking at the TWIFO report and you start to see, well, why are some weeklies look like they have a little bit more action than other weeklies? Because if you look at the week 3 contracts in the table, what you're gonna realize is those have really taken the place of what the old serial options were. So if you, for instance, if you're looking out at the EW3J7, that expires on the 21st of April. That's like the old April serial contract. So just keep that in mind when you're out there looking and you see, oh, the EW3s happen to have more open interest and probably more volume on a regular basis. That's because those really have taken the place of the serials. And as much as the weeklies are hugely successful and popular, the serial, the quote unquote serial weeklies are going to be are more than likely going to be that replacing that third Friday expiration, just like the regular quarterly contract. So that's just a little bit of an FYI for people that are out there paying attention. As far as adding to what you talked about from a volume standpoint, I mean, I went out there, the 1975 puts in the contract expiring on the 7th, those are way out there. So those are outside the third standard deviation. So I'll be curious to see if Tim has any insight as to why somebody might go out that far for that many on that given day. And like you mentioned, in that same month, there were also some of the 1965s that traded as well. So you got people going pretty far out there, and Who knows if it's like an end of quarter deal where they had to cover some risk based on a certain VAR. I'm not really sure. But when you see big trades like that, many standard deviations outside, that's what it leads me to believe. But again, I'm not an expert. I'm just guessing based on my experience and just watching what's going on in the markets in general. But we did mention already vol's low. Vol's gotten lower this week. As much as we're kind of moving up, we are sort of trending sideways a little bit. We had the big run up and we're really sort of just bouncing around at this point. So for me, I start to look at being on lows that are approaching 5-year lows. We're not quite at 5-year lows, but and this is another question I have for Tim if we get a chance to throw it out there. Because there are so many things that expire so quickly in the S&Ps and stuff like that, does the market look at like a 30-day constant maturity contract and a 60-day constant maturity contract? Because, you have these expirations rolling off and they're only around for so long. So I've been looking at the 30 and the 60-day, and that's where I'm getting my information about the lows over the near approaching 5-year lows on the volatility level, because you have to generalize at some point. So that's where that statement comes from, and we can go out there and look, then there are always going to be something, given that we have so many expirations, always going to be something near a 30-day and near a 60-day. But that would be the gauge I would use if you're going to go out there and look for a low volatility expiration. I tell you that the 30 and the 60 are, and probably the end day expirations in general are near their lows, but those are the ones I look at, and those are the ones I start to pay attention to and see what the volume is there, what it looks like, what the volatility looks like, what the skew looks like. But just to sort of kind of wrap it up from a skew standpoint, when you go out there, make sure you look at the QuikSkew, because that's going to tell you the richer cheapness. And basically across the board, even out to the furthest dated 1-year contract in the March 2018, we saw that sort of the twisting of the vol curve, where calls got a little bit better bid and puts got a little bit better offered. And again, you have to keep in mind, when you're talking about 10% rich or cheap today at the money or something like that, when you're under 10%, when you're at 8% on a volatility, you're really talking about the range between a 7.2 vol and an 8.8 vol. So it's really not that big of a spread between these 25 delta out of the money options. So there's probably some interesting things that are going to happen with the way that curve looks, or maybe some trade around those strikes that are near those delta of an option. So I don't think we've seen something this tight. We're seeing it tighter because of the levels of the volatility, but it's still pretty tight just from a percentage standpoint itself.
Tim, that's a lot to unpack there. We covered a lot of territory, a lot of activity, but anything coming to mind there in regards to the activity I just highlighted, or maybe some of the questions that Nick had for you before we move on to some other products?
Sure. So I think in general, I kind of agree, I think, with a lot of what Nick had said, or kind of the intuitive aspects of his points, where if we look back a few Fridays, right, on March 3rd, where we traded, I think, between about 900,000 and 1 million option contracts that day. More than 60% of that volume was in options that expired within the next 14 days. And that represented kind of about 44% of the open interest. So we're kind of seeing the continuing trend of, I think, the street in general is going more and more short-dated in its options, because that's where they're finding perhaps more of the outsized moves with respect to volatility. So then when you look at the kind of longer-dated trades that Nick was alluding to, kind of, like the ones, I do agree, I think it's more around rebalancing. These may be some kind of automatic programs that people have and are using options to portfolio rebalance. I do think it's enhanced by quarter-end activities and month-end activities in general. We tend to see some of those trades being presented in the market. So I kind of agree. I think the other thing, going back to skew for a second, which I think is interesting, is why I think I reinforce Nick's points around going back to the tool, because when you're seeing the change in the relative richness of the puts or the calls and vice versa, that I think the thing that customers and market participants really need to focus on is that what are the motivations of different market segments right now? And if large capital commitments used to be buyers of puts and now they're sellers of puts, what is that going to do to skew these days that it wasn't even doing maybe 2 months ago, 3 months ago, 4 months ago. So I think it's a matter of making sure that when people are seeing these dislocations observed in the market, that they're using some of these tools that Nick and the folks at QuikStart have put out there to really try to understand what the motivation of the trade is, or what's really being presented in the market, because I think some of the old adages that people have built careers on may not necessarily hold true anymore these days.
Yeah, that's true. You know, a lot of the things maybe we all kind of learned in our early days in the marketplace. Not exactly the way things play out anymore. Speaking of playing out, we could spend a lot of time talking about indices. I know a lot of you want us to, but I know there's a lot of people out there who would also riot if we didn't at least touch on all things crude. Seems like we got to hit on crude every week, so let's get on into that as well. Same thing, follow along. CMEGroup.com/TWIFO. Just grab it from the energy drop down there, and you'll see exactly what we're talking about. WTI American over there. And it was another interesting week, and people have been saying to us, hey, you know, what's going to go on with crude? What's happening with crude? What range are we going to be in? We saw the futures drifting up about two and a half handles or so this week, getting back north of that ever popular, ever watched 50 handle again. So seeing some action and surprise, calls leading the charge. We'll get to that in a little bit. Of course, volatility has been a story almost as much as equity, and the lack of equity volatility has been a story. The lack of crude volatility has been up there as well, with a lot of people asking and writing and talking about that and what's been going on in crude volatility. A lot of different ways you can look at it. Go over to WTI and watch it directly. You can look at OIV, which is the VIX of WTI, or a lot of different ways you can look at it. Either way, it's back in the doldrums again this week, taking on the chin. You know, we saw that brief flurry, that brief spark of life that coincided with that sell-off out there in WTI, and as Nick and I said on the show that week, unless that sell-off continued, didn't seem like that vol was going to stay there. And of course, the sell-off didn't continue, and the vol did not stay. Coming back off again, we're seeing, you know, that 30-day implied out there in WTI around that 27 or so level, which is again fairly low when considering the floor for most of 2016 was in the mid to high 30s. So yeah, substantially lower levels, and it doesn't seem like we have a lot of opportunities. Certainly with a you know, nice little slow, easy rally this week, seeing a lot of opportunities for vol to come in. Speaking of that rally, what was lighting it up this week? Well, it was once again the front month calls here. Front month doing nearly half of the volume, about 46% this week. 52 calls lighting it up. Not a surprise. That's right around where we shook out there in the futures. Nearly 30,000, about 28,000 and change, with the lion's share of those coming on Wednesday and Thursday, about 8,800 on both days, which is kind of interesting. So maybe some relations between those trades going up there. Number two, hot on its heels, were the 50 calls, a little less optimistic, with about 26,000 and change of those lighting it up this week as well. Of course, the puts were not one to be outdone too much. The 48 puts, with about 19,000 of those going up. The lion's share actually today, about 6,000 and change. So the puts still lighting it up. Then we go a little bit farther afield to the 45 puts out there in June. They were also lighting it up to the tune of about nearly 18,000, 17,000 and change. Again, fairly even and consistent throughout most of the week. So there's been a lot of interesting action out here in WTI. You know, before I even get you on the QuikSkew here, Nick, I do have a thought, and Tim, I want to get your thoughts on this as well. I know you're an equity guy, you're not a crude guy, but this is the question I've put to pretty much everybody over there at CME. I want to get their opinions on it, and you being in the equity options world and index options world where weeklies are so prevalent, I'd be particularly interested in your thoughts on this, which is, this is the question we've been asked by our listeners. Nick and I have pondered it a lot. Like I said, we've asked a lot of CME people this as well. We see a lot of action in the equities when it comes to weeklies and the indexes. A lot of people love, you can't get enough short duration products out there. We get into a product like WTI, though, which is heavily front month, about, as you said here, about 46% of the volume this week coming in the front month. We're not seeing the commensurate interest in the weeklies. It's a very interesting thing. They're obviously listed, they obviously trade, and yet for whatever reason, they're not still attracting that same interest. I'm curious, you who spends, I'd imagine, the lion's share of your time looking for new ways to add weeklies and short duration contracts, what are your thoughts on why that hasn't translated yet to the energy complex, in particular to WTI?
Yeah, I think that's a great question, but it's probably a little bit outside my area of expertise. I think in general, with any kind of new product offering or trying to introduce new innovations, sometimes these things just take time, right? So I think it's just a matter of those listeners out there that if there's something that's not working for them, or maybe a hindrance to adoption, is that reach out to the exchange and provide some of that commentary. But I would really just kind of defer to if you're really interested, you could take the global head of energy products at CME would be Pete Keevy. He's probably much better equipped to answer that question than myself.
Well, I know. I like throwing you in the deep waters a little bit, but we've given that to everybody at CME. We'd like to get your economist, to Derek, to everyone we can get our hands on over there to kind of get their thoughts on it. I wanted to give you a chance to weigh in as well, because it's an interesting question and probably speaks a lot to the use case and the end user of the product, as well as maybe some of the nuances of the contract itself. Like Blue was pointing out, it's a lot of different perspectives on it. I wanted to see what the equity guy who's launching a lot of weeklies, what he thought about this. Speaking of what you think about this, Nick, a lot popping off this week out here in crude, underlying moving, vol kind of not so much coming in the other direction a little bit. So if you're a little bit of bullish premium out there in crude, perhaps not the week you've been super excited about, but what was catching your eye out there from a vol, from an activity, or even from a overall QuikSkew perspective? I didn't point out, by the way, there was some action in the end of the year stuff too. We got the Dees 2017, 55 calls going up about 6,600 times, and all the way out to Dees of 2018, a year beyond that, about 2,500 of the 65 calls. So this is kind of a trend we've been seeing a lot as well. Longer term upside still in play, and was in play again this week. That said, Mr. Nick, what's catching your eye this week out here in WTI?
Well, it's good to see that Mark actually goes up there and changes the expirations, because you can get a lot of extra information when you start looking at some of the stuff outside of the first calendar year.
Got to tweak the expirations. It opens up a whole new world.
A whole new world. And the thing, we mentioned it all the time, but it's worth repeating here. In the WTI contract, you tend to see outside of the first year, you're getting the lion's share of the volume in open interest, but you start to get to if you go look at the June and the December of each of the other years that are covered in Quick Strike, you're going to see that's where the majority of the volume is in the subsequent year. So you don't have to go and put everything out there to take a look at it. Typically, if you stay within the June and December contract, you're going to see where the action is. To elaborate a little bit on what you said, I mean, or to just follow up, you're not seeing. I think we're seeing a little bit bigger range in the strikes that traded this week than we did last week. Last week, I think we saw a really tight sort of, maybe even 5 around the money. And this week, we extended a little bit further on the downside in the front contract, right, which you mentioned is the most active contract, all the way down to the 43 strike, with a lot of openings down there. And then the upside, we really didn't see much play outside of the 55 strike. So, again, we'll say the same thing. We talk about it all the time. When you start to look at how the WTI is trading, we're trading within the range of this 45 to 55 right now in the May contract. The 50 puts are the largest open interest, followed by the 48s and 47s. 47s is where we were playing all prior last week, and where we tried to extend below 47, and we really didn't have much success there. So when you start to hit those bottoms, those become pretty good support levels. And right now, again, I think now that we're back to the point where we're up above 50, I don't think we're going to see 50 as a hard bottom, but I don't think, we got 47 and 48 strike really kind of strong from an open interest standpoint outside of the 50, and then really big open interest on the 55 strike. And that probably is outside of the May contract as well. And you can go in and look in some summary reports on this as well in Quick Strike and Open Interest Profile tool that's on the CME Group website. So again, pretty range bound. We saw some, we've been talking about this for a long time now. We saw some similar activity in terms of volatility. We see some, we talk about 2% being sort of where people start to bid the volatility up. So you see a 2% change in the underlying. We saw a little bit of a volatility push higher. And again, it tries to go down, it can't, it comes back, and we see volatility get handled pretty well again. So, not a lot of strike range. You mentioned the 65 strike out in the December 2018. So there's some optimists that are trading out there, but who knows? Again, we don't really know the motivation from that standpoint, but lots of range, volatility still down, down today, down all week, about 3%, 3+% across the board. And what we're seeing is, again, very similar to what we talked about, even in the indexes a little bit. we're seeing the calls are less cheap and the puts are less expensive. So as we start to get in sort of this low volatility range bound, you're going to see this vol curve smile start to normalize might not be the right word, because that would mean it would be balanced more or less, but sort of just become a little bit more, balanced might be the right, normalized or balanced is the right word. So you're getting where you have a sort of equal ability to go up or down here. And I think we've proven that, or we've seen that we can't really go down too hard. I think there's a pretty hard bottom down there, and it's going to be supported by OPEC and the producers from that standpoint. And then 55 has been where, the market's tried to push through. So right now, even though the vol's low, I still think there's opportunity in not being long the vol. When you start to look at the strikes that come into play, look at the strikes that are big open interest, there's some strangle plays out there probably. Again, just looking at the numbers, not again having any real opinion one way or another, but just looking at some potential opportunity out there. So if you go look at the QuikSkew numbers, when you're out there, you're going to see in the first in the May contract, which has about 17 days, this you can discount this a little bit. The calls are richly at the money, and the puts are also richly at the money. So as you move towards expiration, the smile becomes a little bit more normal. But as you go out on the term structure, you're going to see that the smiles are still crooked, meaning the puts are still bid, the calls are still offered to the at the money, but they're not quite, as I mentioned initially, they're not quite as bid and they're not quite as offered as they were. And the other big thing, and we talked a little bit about it last week, but I think we can reiterate it again here today. If you're looking at the vol term structure, what you're going to notice is the May and the June are significantly below the July, and the July is above the August, September, and for the rest of the term. So we mentioned why that might be the case. The OPEC meeting is in May. The June contract does not encompass the OPEC meeting, so that's why we're seeing the volatility probably a little bit more bid in the July contract. However, as I was looking at this for the show this week, if you go look at the open interest in the July, it's not a tremendous amount of open interest in the July contract in comparison to the June or the May. So from my standpoint, that really means that again, just drawing on some experience, you get a low volume, low open interest contract. You tend to be able to keep that volatility settled a little bit higher until people realize that it's out there and start offering it down. So from my standpoint, it looks like there's some calendar spread opportunity here in terms of, getting a June contract that's trading around 26 and selling a July contract that's trading around 28.5, because even if you did that from a short vega, meaning short volatility, and gamma neutral, meaning your deltas are going to move the same in lockstep as the underlyings move, that seems like a pretty good opportunity, because even if vol continues to get hammered, you're still short more July, you're short more vega because you're short the July options. And if the market does move, and it moves significantly, you're going to see that June catch up quite a bit from both a volatility standpoint, and you'll be covering your gamma between the spread differences between the June and the July contract as well. So that's what I take away from everything that I'm seeing, outside of the fact that we're kind of trading within a range. The strikes that are trading within a range. There hasn't been any big posturing in any individual strike, but for my money, taking a look at the term structure, and even if doing even something like a June, July, and September butterfly, where you're selling the July twice and bounding it with a SEP and a June contract, I like that trade right now, given the way we've seen the term structure react when the market actually does move. It flattens out really quickly. And as the market, because it's in so much, I don't see how you get hurt too much on this June contract, which still has 47 days to expiration.
There we go. You heard our opinions. Now it's time for you guys to join us. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. Like the man said, this is the portion of the show where you guys take the reins, the inmates run the assignment, and you guys get to send us all of your crazy questions and fun tweets and interesting ideas you want us to explore on the show. We do love your questions. We read them all, even if you don't get a chance to answer them all on the show. Keep them coming. We do love to hear from you because you always send us in some interesting directions that maybe we hadn't considered at the start of the show. Let's kick things off. I'm actually glad you're on for this one here, Tim, because we get hit up about this kind of question all the time, and we can only speculate. But you're actually out there putting the new products out, so you can actually talk about this. I'm going to kick things off with this question from A Joban. He asks, when are we going to have weekly options expiring on every day of the trading week? So effectively, I'm asking, when are we going to have daily options? Well, Tim, like I said, this is kind of your purview, your bailiwick. You were just talking about how you're adding some new products ahead of the upcoming elections there. So what do you have to say for our friend here, Mr. Joban? And also, if you want to break some new product news here on the show, feel free. There's nobody listening. It's just me, you, and Nick. So feel free, have at it.
Sounds good. Well, I can't necessarily predict the future, but we are constantly listening to traders and market participants to understand what their needs are. And we're really trying to develop new products that meet those needs and alleviate customer pain points in the marketplace. So what's interesting is I think some of the feedback that we're getting now from market participants is that kind of Mondays, Wednesdays, Fridays are kind of good for now, right? There are some things that are facing the market makers, whether they be some of the rules around capital treatment or risk-weighted assets and leverage ratios, that for new things for us to continue to add into the S&P 500 complex, we would kind of have to take from other parts of where they're currently quoting now to maintain some of that kind of constant bandwidth. So I think, we don't have any current plans, and again, I can't predict the future, but your listeners should take comfort in that. That doesn't mean nothing new is coming for them. We actually announced this past Wednesday of this week that on July 10th, CME Group will be launching Russell 2000 E-mini futures and options on futures. So we're very excited about that. That is a deal we executed with FTSE Russell back in August of 2015, but now we're entering the period of when the Russell 2000 will return to CME. And on July 10th, we will be introducing the E-mini Russell 2000 Index futures, as well as futures on the Russell 2000 Growth and Value indices, as well as BTIC, which is the basis trade index close on those future products. And I think most important for the listeners, they should know we're rolling out options on the E-mini Russell 2000 index futures, where we'll be offering quarterlies, weeklies, the week 3 serials Nick alluded to earlier, as well as end-of-month options. So while we're not quite ready to do dailies yet in the S&P, plenty of stuff coming down the road for your listeners to get involved in.
There you go. There's a whole suite of new products. You can just skip the wrap up at the end there, Tim, because you already hit it all there. But you're right, a lot of cool stuff coming on. I guess it is kind of interesting to see that you're not hearing a lot of that too, because I guess for us we hear a lot of that, but it depends kind of on the programming and the context. For something we're doing that's very heavily retail oriented, retail just seems to want nothing but endless more weeklies and effectively daily. So we hear that drumbeat a lot. You're right, on the institutional side a little bit less so, even though there is a demand for that there. And particularly if you're talking to like the industry side, like you're right, the market makers and those groups, they're extremely reticent to adopt any new product. So there is a bit of a schism, a bit of a dichotomy, a gulf, call it what you will, between the different sides of the marketplace there. Retail can't get enough. Institutional, yeah, but maybe a little bit leery. And then the quote unquote, the actual market making crowd, the industry kind of exchange crowd, maybe a little bit more reticent on that one. Any thoughts on this here, Nick, before we move on next one? Weeklies are becoming effectively dailies?
I mean, Tim's going to have the complete answer as far as the index goes, but just to remind everybody out there, there are daily options on the crude and the nat gas as well. So, you can, if you are trading those markets, those are available. Now, again, you have to look and see what the liquidity is, but as you start to get these different days of the week, weekly options, you're more or less are trading in that area anyway. If you go look at what the days to expiration is on the TWIFO report, you're going to see that you have yourself covered for the most part, and beginning week, midweek, end week, or over the weekend. So, but keep in mind that there are dailies out there that do exist for some of the energy products.
Good point, our friend here. Obviously, only looking at the indexes. So the short answer to your question is no, Mr. A or perhaps Mrs. Joban. But there are, as Tim mentioned, a whole suite of new things coming. And as Nick mentioned, we do have dailies in some other products. So if you want to go a little bit farther afield away from the indexes and the equities, They got you covered there. Since we're talking CME, let's hit on another one here. We got this one comes from StockAce. I like that handle. He or perhaps she asking, does the CME's Futures Institute offer options education as well? If not, can you recommend any good outlets that do futures options education? Well, the latter part is a challenge. The number of people out there doing options education on futures options, it's slim pickings to say the least. So not a lot we can recommend, which is why I'm glad you asked about the Futures Institute at the top of your question, because the name does imply futures. But if you head on over, if listeners are not familiar with it, just type Futures Institute into Google and you'll find it, or it's just institute.cmegroup.com. You'll see the headline of the page is Start Learning About the Futures and Options Markets with a variety of courses designed to help you at each stage of your trading journey. If you go down, you scroll down a little bit further, the bottom left corner of the page, you see Introduction to Options is one of their courses that they offer, in addition to Introduction to FX, Trade and Risk Management, and Trading and Analysis, as well as Introduction to Equity Index Products, one I'm sure you're a big fan of there, Tim. So yeah, it's if you look at the page, you'll see, and you start digging into their coursework, the name is Futures Institute, but they offer a little bit more than that. I don't know. Tim, let's start with you. Obviously, you must interact with these folks at the Futures Institute. What do you have to say for our friend here, StockAce, who wants to know what kind of options education do they offer?
Yeah, Mark, I would just reinforce what you said, that there's a tremendous amount of free tools and educational resources available for traders and market participants or hobbyists to get themselves more informed about trading these products. The one thing I would mention is that, I think as to kind of what you were intimating in the information you were providing, is that we're actually in the process of rebranding the CME Futures Institute to now just calling it CME Institute. And that's why the web address is now institute.cmegroup.com. Is because while it did start out mainly, as the listener asked if his handle is StockAce or her handle is StockAce, it was really more for some of those active traders who are trading stocks. How do we bridge the gap for them to get them involved in futures? But over time, the need by market participants for education and the thirst for knowledge is always demanding and robust. So I think this is a testament that we now have dedicated more resources, more videos, and as a firm, we've actually re-upped our initiatives around creating some of these free content for our listeners and offering those free online classes. So it's really much more than just futures education now. And if you type in the search field options on futures, you'll see tons of things, both for intro as well as product-specific things, whether it be equity or other the asset classes. So I would definitely recommend for listeners to check that out.
I like that rebranding. Why should our options fans feel left out? Well, I'm sure we'll have a lot of people like that, like StockAce. We'll be excited to hear that the rebrand is coming, and that indeed it does have a lot of futures options content there already. Nick, any thoughts here? You ever check out any of these courses?
Yeah, I'll obviously reiterate what Tim had to say. I always go to myfuturesinstitute.com and it takes you there, but obviously it's institute.cmegroup.com now, and they have that nice, pretty elaborate course that you can get right from the homepage. I just sent Mark a link, and maybe he could tweet it out. A while back, the Futures Institute had me do a little 5-part video series that did an introduction to options on futures. So we'll put that out there. You could take a watch. And it's 15 minutes long, but it covers sort of the basics, and it might be a good starting point. And on that page itself, there's a bunch of other things: introduction to futures, introduction to options, and then additional resources that just sort of talk about the fundamentals of options on futures. An option is an option, all those kind of things. So there's a lot of stuff out there that you can find really easily just by having and this information I talked to you about is under the follow the market section if you go out there. So follow the markets, and then you go to there's an options link over there, and you'll start to see what I'm talking about. But Mark will tweet that link and have a look and tell us what you think of the video itself. The other thing to keep in mind, there's also an initiative by the retail group over at CME, and the URL is activetrader.cmegroup.com. And what you can do, what happens there is they have a resource site as well, but they also push out a newsletter every day that sort of talks about what happened in the market that day, and then also does some features with some tools as well as some charts that they try to explain based on what happened in the market that day or that week, so you can get some insight as to how the futures and options are being used by the people that are trading the stuff out there. So that's another place to go. That's activetrader.cmegroup.com.
There you go, Nick. Just a font of information. That's good because we're going to need you here for our last one. This comes from AM85. He or she wants to know, how can you guys tell when you're looking at the reports if a trade is opening or not? Thanks and love the show. Wish it was daily. Well, be careful what you wish for. That would be a ton of show. I don't know if Nick and I can handle that, but you're not the only one to express that sentiment. So who knows? Maybe someday we'll explore that idea. Right now, fortunately, you got to settle for once a week. It doesn't mean you can't play with the futures options throughout the week. Again, that link is live all week, cmegroup.com/TWIFO, not just during the show time. So you can generate your own reports whenever the need strikes you. Hopefully that helps to fill some of that emptiness, that void in between episodes of TWIFO here. Two answers to this question. Obviously, the basic one for maybe newcomers. Obviously, open interest is the key there. So if your trade volume is exceeding your open interest, a pretty easy math to see that you're going to be opening, of course. Otherwise, you have to if it's less than that volume, you have to kind of wait until the next day to see when the open interest changes, exactly how it changes. In terms of the specifics that you're asking about, how do we tell on the quick strike report? Nick, since that's your baby, I'll let you run with this. How do we tell when we're looking at these reports? How do we tell, like Mr. AM85 wants to know, how do we tell when things are open?
Well, it's not going to be so easy from the TWIO report, but what we, because on the free report, none of the links are active, but on the subscription reports, you're able to click on the links, and then it's going to show you the volume and how much of that volume contributed to a change in the open interest. However, on the open interest profile tool, which is free at cmegroup.com/QuikStrike, QuikStrike, you can go to the open interest profile tool, and on the summary as well as the individual expiration pages, there is an openings tab. So you're able to get a report to see what strikes opened in a particular contract or across the entire product on a given trading day. Now, keep in mind, during the day, there's a bunch of volume. There's no change in open interest during the day until everything's gone through clearing and everything's been cleared and completed. And then we start running our new reports around 11 p.m. Central Time. So when you get up in the morning, or if you're getting up at night, which is our morning, or our night, which happens to be your morning if you're overseas, et cetera, it's 11 o'clock Central that we start to run those jobs where you're able to see that change in open interest from that trading day. But again, open interest profile tool, the openings tab, that will give you a full report of the strikes that had zero open interest and then traded that day and had basically were open that day. But as far as the report goes, the one thing that you can do in the most active column, you're going to see how much the open interest changed. So we're going to rank it accordingly, so you can see the particular strike and how much that changed. And we don't have the details of where that started, but you're getting a percent, so you can see if it's a massive percentage, then you know that it was basically started at zero. Okay, so that's the best answer I can give you. You're going to have to go to another tool, which is also free, but it's available. So if you're really interested, you could find it.
All right, everybody. That music means we've come to the end of another epic journey through the world of futures options. But before we go, I want to check back in with my cohorts here on the old TWIFO program, see what's coming in their neck of the woods that may interest you. Tim, we'll start with you as our guest over there in the CME hot seat. You kind of let us know a little bit already about all the things you're working on, but let's hit it again in case they missed it or in case you forgot to include something there. You guys are always cranking out new products. You always have new things coming down the pike. What can our listeners look forward to from your team over there at CME Group in the coming weeks and months?
Yeah, for sure, and thanks again for having me. The things that we have in the hopper are, again, on Monday, April 3rd, this coming Monday, we're launching the Monday weekly options on the S&P 500, the BIGs and the E-mini S&P 500 as well. We're excited about that. We're hoping that they are as successful as our Wednesday offering to date. And then the other exciting news, which I already talked about, is on July 10th, CME Group welcomes the Russell 2000 home. It's making its return to CME after about 10 years, and we're very excited. And we'll be launching futures and options on futures on the Russell 2000 on July 10th, and very excited for it. And the feedback so far from customers has been overwhelmingly positive, and we're really looking forward to bringing that to the market.
There you go, listeners. You heard it from the man himself. Check it out if you want to learn more. CMEGroup.com. While you're there, of course, head on over to CMEGroup.com/TWIFO, or maybe visit the formerly Futures Institute, soon to be CME Institute, if you want to learn a little bit while you're over there. And Nick, same question for you. You guys are always cranking out interesting new tools over there at QuikStrike. What can we look forward to in the coming weeks?
Well, we are doing our level best to make sure that the Monday expirations are out there and available on QuikStrike. There won't be any. I mean, we're going to try to interpolate that volatility from some of the Wednesday and Friday curves. So hopefully those will be out there Monday morning, so you can at least have some indicative levels of where those trades might be. As far as new happenings, I mean, we are on some of the premium stuff. We have some new kind of cool stuff going on in the historical volatility tool. We, restructuring some of it in order to make it a little easier for people to dive more deeply without having to feel overwhelmed when they first look at things. But I think more importantly, we did talk about it internally, and I think what we're going to definitely do is, hopefully for, we'll say before the end of the month, we will make the TWIO report, the TWIFO report, we'll make it live so the links are active for the hour that the show is on. So you can really get a good idea of what we're talking about, and you can dive in and see the information that we are discussing. So if you click on a most active 48 put, for instance, in the front weekly contract in crude, you're going to see what days it traded, how much volume it was, and how much that open interest changed. You'll be able to see the historical volatility, be able to see the 25 delta risk reversal historical volatility. So for that hour, so it's an incentive to come and listen live. So you'll be able to dive in and get a lot of premium information that's available in QuikStrike.
All right, thank you for that, Mr. Nick. And on behalf of Nick and Tim, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for all of you who joined us live, we love you guys too. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered. With market data reports ranging from open interest to the term structure of volatility, QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.